Good morning, everyone. This is Pat McParlin from Opus, and we're excited to welcome you to this morning's webinar, 2018 Trends in Third-Party Risk Management and Assessment. I'm delighted to be here today with a distinguished panel of speakers, and I'll start by introducing them to you and then talk a little bit about the format of the webinar, which is a little bit different than the sessions that we have done so far, and I'm pretty excited about it. We have a great group, many of us who are in person today, which is exciting. Our first speaker is James Gellert. James is Chairman and CEO of Rapid Ratings. James has a very strong background in finance. He's a recognized authority on ratings, independent research, and analytics tools companies with over 20 years of experience in entrepreneurship, capital markets, and investment banking. He has experience leading a variety of companies in technology industries, and he speaks regularly on these topics. And looking forward to hearing what you have to say today, James, on financial health, integrated risk, and a number of other topics.
Thank you, Pat.
Okay, and I just realized I'm not sharing my screen, so you're not seeing the faces of all our panelists, and there you go. So there you see James Gellert, the first person that I'm talking about. Second person is Charlie Miller. Charlie is the Senior Vice President of the Santa Fe Group and the head of the Shared Assessments Group. And Charlie Miller is also a person with us here today. And Charlie also has quite a distinguished background, and Charlie's responsibilities include the Shared Assessments Program, which I hope that you'll tell us a little bit about, Charlie, when you speak.
Yep.
And he has also vast industry experience. He's led vendor risk management and financial services initiatives for a number of global companies, including being the director of vendor and business partner risk management at AIG. He's implemented third-party risk management programs at the Bank of Tokyo, Mitsubishi, and Merrill Lynch. So I know, Charlie, one of the things that you and I have had a chance to talk a lot about is information security and cyber risk, and how companies are using control-based assessments to deal with the third-party risk of information security. So looking forward to hearing what you have to say about that, as well as other third-party risk trends. So,
as am I, so thanks a lot, Pat.
Great, great. I feel a little bit like a game show host, as I'm introducing you guys here, so sorry about that. But our last speaker is not in person. He is in London. Thank you for joining us, Nick, from London, and underscoring that third-party risk is indeed a global issue. Nick is joining us from C6 Intelligence, which is a trusted and independent partner of data intelligence, focusing on anti-bribery and anti-corruption, definitely a rising risk area in third-party risk. And Nick himself, he's a product director at C6, and he has a lot of experience in financial crime compliance. He's worked at major banks, and he will speak to us today on a number of different areas and trends he's seeing. And he's particularly experienced in anti-bribery and anti-corruption, as I mentioned, and he's somewhat of, actually not somewhat, definitive expert on Brexit, and also GDPR and a number of other areas. So thank you for joining us today, Nick. So
That's a pleasure to be here, Pat. Thank you.
It's a pleasure having you. So before we hear from you, distinguished folks, I'm going to keep the microphone just a couple more seconds and just speak a little bit about Opus, as we always do in these sessions, and just remind you of Opus's mission, which is to free your business from the challenges and complexity of managing customer, supplier, and third-party risk. And the key words here are free your business. As we've discussed before, often, we can think of risk management and compliance as burdens, fines, something you need to do with your business. And it's our point of view, after speaking with many of you, that it's also a positive opportunity and a strong potential for competitive advantage. A way to free yourself from concerns about specific regulations and fines, to find better ways of improving efficiencies and effectiveness, to focus on your priorities. An example we speak about regularly is global expansion. You may be expanding into risky geographies where potential for bribery and corruption may be unfamiliar, or into new technology areas that pose obvious risk, yet these areas also are the areas where growth potential is obviously greater as well. So how can you not avoid risk but harness the risk to free your business? And so that's kind of the thought behind Opus and our reason for being, if you will. So with that, I'd like to turn to the 2018 trends. Before we do, we're going to try something a little different here. We're going to try a poll. Since last year, has your concern about third-party risk increased, stayed the same, or decreased?
Wow, there you go.
Yeah, so this one is, silliness about the Eagles aside, I just wanted you to be able to test it. And so this is, let's give this a minute or two to cook and see how the folks on the phone are feeling about the risk. Well, it's pretty clear that so far the concern is increased. So I would say this poll so far, panelists, is less equivocal than the Eagles, would you say? I also see a couple of questions coming in, and so we will be taking questions after the panelists, but feel free to throw questions in as we go as well, and we'll do our best to take them during the session. Okay, so we're still voting, but stabilizing looks. Feel pretty confident saying that your concern about third-party risk has either increased or increased significantly for the most part. I'm going to move on to the next question, which is more specific. What are some of your third-party risk challenges? And then we'll talk with the panelists about some of the trends that they're seeing as we enter 2018. So if you want to pick your top, let's say two or let's say three, up to your top three as you enter 2018, pick some of the things that are of top concern to you, and then we'll have a discussion with the panelists. So Jim and Charlie are seeing this live. Is this interesting to you?
Absolutely.
Yeah. The thing that's striking me as I see the answers, it looks like all kinds of third-party risks are causing concern, whether information security risk, the ability to identify or manage them, staff, budget, varying degrees of concern, but it looks like everything is getting voted on. Thanks for your participation, everybody. I'm going to keep going for another few seconds to give you time to make choices. So it seems like the voting is stabilizing now. It is almost like a football game here where things are pulling up. You see things are, I think they're done, and then information security risks pulls up at the end. So looks like the two risks that are pulling out the most are not enough staff to manage third-party risk and threat of information security risk. And curiously, or perhaps not curiously, this lines up with another survey that we had done in January with the chief information security officers with the Ponemon Institute. And one of the main things that came out of that was not enough staff to manage these cyber risks. It seems like a commonality there. So great. Well, it's great to set the stage and hear what's on your mind. So I'm going to turn it over to our panelist, our first panelist, James Gellert. This is actually a video still. I had intended to show you some video clips from the panelists. I will send you the video links afterward. The videos don't stream too well on GoToWebinar, but to see them in action, I will send you the links after the webinar as well so you can see them real time. But I'd like to turn it over to our first panelist to talk a little bit, and each person will talk, and then we'll open it up to the audience for Q's and A's. So let me turn it over to you, James.
Great. Pat, thank you very much. We always enjoy doing things with Opus, so thank you for asking me, and it's an honor to be participating with Charlie and Nick as well. So thank you, everybody. I would also like to say, as a lifelong New York sports fan, it's good to see that someone from Philadelphia is excited when they can tie with apathy for the success of their team. So look, I think the poll is certainly very interesting, and I think cyber is obviously an extremely hot topic, and it's one that I know Charlie will be covering. So I'm not going to talk about that, although I think it's quite clear that it is one of the principal topics on people's minds. Interesting to see the organizational one as with the second most important concern, the question of staffing. And I would link that to organizational sharing of risk information and the ability to communicate across all of these different areas of organizations that are tackling third-party risk and supply chain risk, because these are I would say one of the commonalities across all of our clients. And at Rapid Ratings, we, through our financial health ratings, are assisting companies in the financial services space, but also in across all of non-financial in manufacturing and retail, pharma, and across 28 different industries. So our perspective is helping people understand third parties, whether those third parties are vendors, whether they're suppliers in traditional supply chain risk management. And many of our clients span into providing credit as banks or as corporations to customers and to borrowers. So our perspective is really seeing people managing risk in a lot of different ways, and one of the commonalities is this question of coordinating across the different areas of the organization, and particularly as we've seen third-party risk efforts grow over the last 5 to 6 years. Depending on the state of a program's evolution, there could be more cohesiveness and more sharing of information across the different risk areas or less. And particularly for those programs that have very segmented or siloed approaches to analyzing the different risks represented on the poll or represented in an overall risk strategy, the more siloed they are, the more people it takes, because the less sharing of that information is being done and used efficiently across the life cycle of managing a third party. So for instance, today, Charlie is going to talk a bit about InfoSec and other areas, and Nick's going to talk representing a big portion of the compliance universe that's looking at risks, and we represent those who are looking at financial. Those could be in an organization 3 totally separate areas, or they could be areas that are sharing information because that information is useful to the different risk professionals who are assessing their particular specialty. And what we have found, both for our financial services and our non-financial services clients, is that financial health itself is a leading indicator of many of these other problems. So companies that are under stress are the companies that are more likely to be cutting corners. They're more likely to have to reduce spend in critical areas like cybersecurity risk. They may be under duress because of the extent of the dollars they're having to spend on cybersecurity risk, particularly as the financial institutions are putting more and more pressure on third parties to comply with OCC and Fed and FFIEC standards. So I think one of the key issues this year is going to be how well organizations are able to coordinate the risk management elements and data that they are organizing and share it so it can be efficiently used to tip off their colleagues. And so they're all speaking from a common language and using a common language to understand risk. And that's from the onboarding and the identification of a new third party all the way through the continuous monitoring, so really across the life cycle. Another hot topic is, of course, digitalization and data organization, and we hear a lot about this topic. My feeling is that if an organization does not have an underlying process in place and able to digest all of this new data that is being gathered through technology, through third-party products and services, through the SaaS solutions, and the variety of other ways that they are aggregating data. If they're not organizing it and using it, then it's just a mountain of data, and it will just be a poorly spent dollar on a third party that's helping to aggregate and analyze, as opposed to actually being able to use that as an informative set of insights that can be implemented and operationalized to effectively manage risk and to increase all of the elements of a company that third party touches. Part of that is the ability to continuously monitor third parties, which is something that is more important for financial institutions for regulatory purposes than for supply chain risk within corporations to some degree. But also a common problem is the ability to look into the depths of a third-party group into fourth parties and fifth parties, or in supply chain terms, to be able to look into tier 2, tier 3, tier 4 suppliers. But again, if the data and the analytics that are being gathered aren't operationalized in an efficient way, then that data is going to be less successful. A big topic which has become more highlighted over the last 2 weeks is how financial health and the ability of companies to be able to weather the ups and downs of the market and their needs for capital, just how critical that is. Volatility is back in the market. And other than the Olympics, the second most exciting thing to watch in the last week has been the stock market. And it's a great way of understanding, for those who are less capital markets trained or savvy, is just to appreciate just how much is happening in the space. So the fact that the market is moving up and down in some pretty wild swings, that volatility is indicative of signs of stress. And those signs of stress will hurt the fact that many companies have been able to borrow at incredibly low rates over the past 5 to 8 years. Low interest rates have masked problems in people's third-party groups and in their supply chains. And they've masked it because they've allowed companies to raise capital at cheaper and cheaper rates and with much less discriminating credit differentiation by the investors. As the market gets more volatile and as that changes, those who can raise money are going to have to pay more for it, so it's going to change their cost structures. And there will be lots of companies that cannot raise capital and refinance their debt. So for companies in third-party groups, whether it's a supply chain or a financial institution's third-party group, there are these little time bombs that over the next 3 years are going to go off. And if one is not on top of who's financially healthy and who's not, then they're going to be stung by this, and this is going to hit them from a reputation risk perspective. It'll hit them from a business disruption, and it'll hit them from a revenue loss perspective. So I think all of these are critical areas to consider. And then the final point I'll make is that when evaluating third parties, because of this backdrop of increased volatility, it's more and more important to be able to assess third parties on industry-specific bases and to do it in a common way, because you can't have a one-size-fits-all way of assessing risk, because different industries will be, and sub-industries will be affected by the changes in the market in ways that others aren't. For instance, it's important to know that in computer technology, our financial health ratings for public companies have increased and improved year over year, but for private companies, they've deteriorated. And among those private companies, 36% of their debt as a whole is short-term debt. So decreasing financial health in a sector, the private companies in that sector, which are going to represent 75 to 80% of people's supply chains and third-party groups, and high percentage of short-dated debt, which needs to be refinanced. That kind of insight and that type of information is extremely valuable, and to be able to look at that on an industry-specific basis is really quite critical in these times.
Great. Interesting. So it sounds like a couple of key themes coming out of what you said. Elimination of silos or kind of coordination of risk across the organization, making sense out of the data. So I heard you talking about applying organization to the data and also data becoming insight, perhaps, or some sort of making meaning out of the information, and then the importance of the financial health as an element of third-party risk.
That's right. Yeah. And I think one of the polling questions was also very insightful in teasing out that people are still concerned about identifying who their third parties are. So when this many years into third-party risk management and supply chain risk management, the fact that that is still on a poll, much less having significant responses, that indicates that we are still young in the evolution of data management inside of companies, because understanding and having that data organized and being able to act on it is just a foundational building block that everyone needs to have.
Excellent. So as a reminder to folks on the phone, feel free to put in questions through the question tool using the GoToWebinar. We will be taking questions after the three panelists talk about their trends, and we will be taking them throughout as well. So our next panelist is Charlie Miller, and here's Charlie.
Hey.
Hi, Charlie.
How you doing?
Great. Look forward to hearing what you have to say.
So thanks again, Pat. Thanks for inviting us to participate in this event. You as a licensee of our tools, we're really proud to have you as a licensee and sharing the incredible work you guys do at Opus with regard to third-party risk management. And James, you as well, with third-party financials, being a member of the Shared Assessments Program. So that's, and Nick will talk to you after this about becoming a member. So anyway, so we're a membership-driven organization, Shared Assessments Program. We've been around since 2005. We have historically focused on financial industry, and that's where we started out. However, as James indicated, this is much broader than just financials. It's going across all industries: healthcare, pharma, consumer packaged goods, insurance. I think every industry is being affected by this, and we'll talk a little bit about that as well. So we have a trust verify model with the Shared Assessments Program. The trust piece is like due diligence questionnaires that basically are sent to the third party to allow them to respond from their point of view as to what their control environment looks like. And then, so that's the SIG questionnaire that has been around forever. And then we've changed the name of the agreed upon procedures, the Verify tool that we use, to the Standardized Control Assessment tools, so that procedures, because I think that's a little bit more accurate description as to what we're trying to verify with controls that we're looking at a third party. So those are two background pieces around the Shared Assessments Program. I put together some information about what we do with our advisory board and how we brief them, as well as our steering committee, and an environmental impact that we look at, about 7 different topics, including economic, technology, regulatory, legal, demographics, and risk assessments. So those are the areas we kind of look at and kind of get an impact of what those various areas have on third-party risk. So I'm going to speak about a couple of those. I put a lot of stuff on this slide, so we're not going to get to every one of these things, but I think it's important for you all to recognize that these are the things that are driving your programs in a large extent. And obviously technology and the risk and threat landscape, as Pat and James mentioned, we see this as one of the key drivers. And it's really around the exponential expansion of demand for innovation by your businesses. It's really that. It's looking for where do we find innovative companies to deliver what we need to get to our customers in a really timely fashion. And it's around fintech companies, artificial intelligence, machine learning, Internet of Everythings. And we're doing a study with Larry Poneman, should be out in about a month or so, with regard to the IoT, Internet of Things, and its impact on third-party risk. So I think that's really, really important to understand what those drivers are, because each of those becomes a vector into your organization from a threat perspective, and to the degree that some of these vectors are not as mature as other technologies that you have in place to protect your institutions, that's really important for you to understand. I think the other two combination things are really around an increased move to the cloud, which is really a benefit to everybody to reduce the amount of infrastructure you have to support in your own organization. But also that move, as well as those endpoints opening up, really increase the landscape for any type of advanced cyber attack. So, due diligence here is really, really important, and then staying abreast of all the different products and solutions, as integrated as they can be, to protect your organization is important. I put some things here around regulatory and data protection, but equally important is the resiliency component to this, and I think that's another area that needs to kind of come into play. Nick is going to talk a little bit about the regulatory landscape in the EU with regard to Brexit and some of the things around GDPR, but I think 2 points that we really try to emphasize is how does third-party risk influence tone at the top, and how do you basically begin to see changes in direction being driven from the top relative to third-party risk focus, and also third-party risk kind of reporting requirements. So that accountability, after the Equifax breach, you can see that these CISOs and others in those organizations are very accountable and become very exposed if things don't go quite exactly the way you want. I think one other point I'll make on that is critical infrastructure. So we're seeing a lot of work with regard to protecting through the ISAC organizations critical infrastructure, because that holds so many of our keys in their hands with regard to being able to provide our solutions to our clients. I'm going to spend a couple of minutes on risk assessments, not just third party, but nth party, because as James mentioned, it's that supply chain that basically has been evolving and becoming very complex. And the relationships that are not only between you and the service providers that you have servicing your needs, but there's those service providers and their service providers on down and on down. Where are the keys to the kingdom, and where are the key assets that you need to be ensuring, protecting? I think that is a real challenge, and going back to the point that it seems like we're getting better on inventory, but if you ask people if they know who their fourth parties are, it's not so good. So you get a little cloudy as it moves down the chain, so to speak. And as James mentioned, point-in-time assessments, they're good, but they're not where we need to be. We have to get to a continuous monitoring solutions, and those are the opportunities that many of the providers and the startup companies are looking to kind of enhance and provide solutions on. And we see collaboration, disparate pieces of the risk organization doing different things through different mechanisms, not aggregating data, not looking to the first line of defense, if you know what that is, for reporting of risk and reporting in different scorecard methodologies. Very confusing, very unclear as to what individuals then need to do to address the risks that have been identified. So I think that's a really, really big component. And last but not least is do this all for a lot less money with a lot less people, right? So that's the pressure that we're all under to be able to satisfy the high level demands with regard to assuring our CEOs and our executive boards that we are doing the right things with the resources that we have, and we're protecting our brand and also our clients' interest in our companies. So I think that's a summary, but there's a lot more there. So I know that this is all on your mind. So hopefully we'll get some questions in. So.
We actually did get a question specifically for you, Charlie. So people talking about the lack of sufficient staff to manage third-party risk, wondered if you had any advice on tackling that question and specifically working with senior execs on investment to get additional resources.
Yeah, so two things. One is collaboration is key. So especially in some of the industries where there's a lot smaller organizations that have less mature programs, I think, we look to collaboration to provide opportunities for those smaller organizations to network with, various levels of organizations that have implemented programs. I think that's important. I think the other piece is that there's a lot of solutions that are being developed where you can basically assess once, store the results of that assessment in a repository, and then basically make that available. And then the supplier can make that available to any institutions that utilize that. So that's another trend that we're seeing. And the third one, in terms of getting resources to actually accommodate this, always tricky and very unique to your own organizations. But we're working on some techniques for executive board reporting that basically highlight the fact that there's insufficient skills in the organizations that are trying to address these risks. So we're in the same boat as many others on this one, unfortunately.
I think one of the issues around being able to get more budget and more staff is being able to better communicate what the value at risk is. And we find that a lot of the clients we talk to, many of them are able to speak in broad terms and general terms about what value any of us are bringing to the risk management process, but aren't necessarily able to quantify it. And when it's quantifiable, it's easier to bring it up to more senior management for budget allocation. At the end of the day, they're worried about reputation, they're worried about cost, and they're worried about revenue disruption. And if you can touch on how risks in the third-party group are touching any one or all of those three things, it's a much easier process for identifying and quantifying what it is that you want when you can put it against a problem that's being solved.
Absolutely. And I think the other point there too is that there's a lot of different players in this space and inside organizations. So finding the right single, so to speak, focal point for this is important. If it's a chief risk officer or a chief information security officer, you need to begin to think about how you federate some of these solutions, because in a decentralized organization, it's really difficult because you have competing organizational pieces and departments competing for the same dollars, so to speak, and people.
Actually, federate's a really interesting word. I've heard the word, collaboration. And
we can spend an hour on that.
Yeah, so it's interesting word. There's a related question here. Why is there so much resistance from staff in regards to these critically important matters of risk management? Why is it difficult for people to be open to knowledge and change? It seems, the one question is about the C-level, the other is around, kind of people around you and staff. I don't know if you have any other, thoughts to add to that.
Yeah, so just I can give you a perspective. I've done this at 3 different companies, and each one had a different kind of organizational interrelationship model. Some were, very, very centralized and very specific about if it's not invented here, we're not going to use it. So there was a little bit of my car is the best car on the street, and therefore we're going to use it. And also that there's a bit of a threat to the intellectual property of those individuals that have that. So they're afraid they may lose kind of their career path, or may lose an opportunity that may be coming up and down the line. So the whole emphasis here is really to shift that perspective, where you can take advantage of collaboration opportunities and standardized solutions. Take advantage of them, because there's enough risk work to do in other areas to validate whether or not you have the right resources applied to the right threats and vulnerabilities to protect your brand. I think that's the attitude that you have to have. And I did that at one company. The other companies were a little less open to that kind of thinking. So anyway, very much about your corporate culture, though.
Yeah, well, you mentioned that when you said tone at the top too.
Yeah.
Yeah, interesting. And you both mentioned the nth parties and the fourth parties and the fifth parties and the kind of supply chain and suppliers expanding
Right.
out. It's becoming more complex. That's interesting as well.
I think statistically, supply chain disruption comes 41% of disruption comes from tier one or
Tier three or whatever.
your first level of suppliers.
Yeah.
So that means 59% comes from second, third, fourth, fifth, and that's the area that people have the least insight into. So if over half of your supply chain disruptions come from a category of third party that you're doing nothing to address, probably not putting together a particularly comprehensive risk management program. So you have to find ways of getting deeper, and the best way to get deeper into your third party group is to enlist your third parties, enlist your tier ones to help you with your tier twos and your tier threes.
Yeah.
Interesting. Reminds me of what you just said too about the most basic question: do I even know who my third parties or who the people are? And then expanding that out.
If you don't know who all of your third parties
Yep.
are, you certainly don't know who
Fourth or
most of
fifth or
your
whatever.
third parties are.
Right. And that goes down. So your fourth party doesn't know what their fourth parties are. So it just keeps exponentially getting worse. Anyway,
Yes.
enough said about that.
Yes, or as a quote I heard actually from Larry Poneman is complexity is the enemy of security.
There you go.
Yeah. Okay, so our last speaker is, or third speaker is Nick Parfit. So Nick, how are you doing there in London? I'd like to hear what you have to say.
Nick, give us the answer, please.
Yes,
Thank you.
Nick, please with third-party risk and solve it all for us.
Well, if only I could. However, I do think there are a number of things that we can certainly learn from the AML arena and where financial institutions have previously been. If you look at probably maturity levels at the moment, my observations would be that many organizations are, in some respects, 10 to 12 years behind this curve. However, the good news around that is there's a lot that can be leveraged from AML and counter-terrorist financing programs of work. The mistakes that were made by big banks, small banks, the fines that were levied, the progress that was made, and the areas that they need to strengthen and demonstrate to the regulator that they are indeed taking these risks very seriously. And I think you mentioned before, James, around the culture, and I think that's really key in terms of setting the tone at the top. Where we are with anti-bribery and corruption, we're definitely seeing that as being a key theme for 2018. In the UK, we've had the Bribery Act of 2010, so we are seen in the UK to be, particularly by the OECD, as being an effective enforcement regime. But there is again huge maturity or degrees of maturity from big multinational organizations that have already been under fines from the SEC and have put large programs of work in place to address those, to the SME market, where the observations would be that a policy around anti-bribery and corruption is sufficient, and clearly that isn't going to be the case. If we look at the legislative headwinds that are coming out, there's a new head of the SEC under the Foreign Corrupt Practices Act, Mr. Charles Kane. He has a reputation for pursuing non-US companies in a bid to level the playing field. The Department of Justice as well, it also has an FCPA corporate enforcement policy, which came out late last year. But with the focus of this basically on incentives offered to companies to self-report anti-corruption issues. And that's potentially very important factor for organizations to fess up now, rather than be subject to huge fines later on. But importantly, that policy also went into much more detail around clarifications on what the DOJ expects from companies in terms of cooperation and the compliance program remediation. So all of that, I think, means that 2018 will shape up to be a very interesting year, and then certainly through to 2019 as well. Going back, I think one issue or one aspect that Charlie mentioned around risk assessments, we are seeing as well a lot of interest from organizations saying, well, how do we actually manage our third-party risk with our third-party suppliers? What goes into a risk assessment? How do we go about screening? What data should we use? So, again, the overriding theme here from the start of the poll, which was interesting around not enough staff and the inability to identify and manage third parties, took a large proportion on everybody's agenda here. But I think if you get the right risk assessment in place, and again, there are a lot of parallels that can be leveraged from the AML world in terms of the scope and holistic policy and approach, the factors that go into it in terms of jurisdictional risk, the organizations that you deal with, your cleaners in the building are going to be obviously a lot less risk than parts manufacturers that are based in higher risk jurisdictions. And if you can get that risk assessment right in the first place, and you can justify the rationale behind it, then you can start to effectively segment your third-party risk suppliers and deal with the highest risk first, and then obviously medium and low risk at different intervals. So again, very much in the same way that you would deal with customer risk assessment, as long as you lay out a policy, you have a good, strong message to the regulator around that. And in general, and what we've seen with, from the FCA and the OCC and other regulatory bodies around the world, is as long as you have addressed your risk, that holistically where that risk is likely to come from. Your programs and controls may not be perfect, but as long as you've gone through that exercise, you've got the right culture at the top, and you can document things, then that does give you a runway in terms of change on a pace that is achievable rather than breaking the organization. There's also a number of frameworks that can be put into place as well. Again, very analogous to kind of like anti-money laundering and CTF type programs of work. It's about the context of the organization, the leadership, the roles and responsibilities, whistleblowing routes, and a roadmap and program of work in order to achieve that and get to the stated risk appetite of the organization. But I think there's clearly, there's a long way to go actually in terms of ethical behavior. There was a survey by EY last year which came out, which looked at, whether or not certain segments of the organization, what they would do to justify offering cash payments or to win or retain business. And they found that 1 in 3 of board members and senior managers could actually justify doing this. And more importantly, I think 1 in 4 of Generation Y, that's 25 to 34-year-olds, could also justify gaming the system, if you like, to further their goals. So that's, there's a key cultural gap there with, managing the organization that needs to be overcome. Now, in terms of Brexit, it's very much on everybody's lips at the moment, but I guess I'm a little cynical, but I suppose the data does kind of bear out my cynical attitude. If you look at where we voted to leave on the 23rd of June in 2016 to the 29th of March, so 9 months ago, effectively, we had Article 50 triggered. That meant that there was a 2-year countdown to Brexit. We're now February 2018, and little or no progress, as far as I can see, has actually been made. We have a lot of the Remainers pushing the agenda to stay. There's talk of having another survey, another vote on the subject, and there's even language being introduced around Brexit turning to Brino. Love that term. So that's Brexit in name only, which is what they're saying the 30th of the announcement on the 30th of January around a bespoke EU deal was actually going to be. So there's a lot of politicking going around, but in terms of what we're seeing on the ground, GDPR, for example, that's still on everybody's agenda right now. So we're very much focused on that. We've had the OECD working group last year report, which came out recommending some 40+ recommendations to strengthen the UK, and what we're doing around SAR filing under various regulatory bodies of the UK, FIU, Her Majesty's Royal Revenue and Customs, and other bodies as well. So there's a lot of work around that, which I think everyone's still very much focused on. And in terms of sharing of data with the EU and Britain going alone, I really don't think that gels with the overall global vision for the UK of being a driving regulatory body and enforcement area. And it wouldn't be seen, I think, from a good business sense for organisations to be necessarily choosing the UK because it's going to have a lower regulatory enforcement agenda. So I think with all that in mind, it's kind of business as usual, but organizations are very much focusing on the anti-bribery and corruption issue, how to tackle that, and there's a lot to do. And I think the headwinds, as I said, mentioned about legislation or the regulation coming out of the US is going to seriously focus non-US firms' agendas to deliver in this space.
Great, thanks, Nick. So I heard you mention the culture and the tone at the top. Also, it sounds like all three of you mentioned that in some form or other, which is, I guess, not surprising, but always comes down to the people in some form or other. So I wanted to do a time check in that we have about 9 minutes left. I wanted to make sure that folks on the phone had a chance to ask questions. We've actually gotten a lot of questions, so I wanted to start asking questions of the panel. I wanted to ask the first question of Jim. So Jim, well, we got a question around the idea around coordination of risk and whether the thought around the coordination of risk extends beyond internal coordination. So does it also extend through industry coordination? The example the questioner gives is like medical providers coordinate benefits and things across industry. So are you speaking about external coordination as well as internal coordination?
So thanks, Pat. Tamika, who asked the question, I think my real specific comment was towards internal communication and coordination, so there is an understanding and not a duplication of effort, as well as the benefit of learnings across business lines or risk control areas. In terms of coordination industry-wide, this is something that's being explored more in the financial services space than in other areas where there are some utility-type efforts that have come up to coordinate some of the risk management of multiple firms. That's not something that is going to preclude or obviate the need for risk management within an organization, but it will make more efficient some of it. So I think there are some efforts to get some industry-wide effort, and obviously in terms of coordination of risk management, there's no better place to look than what Shared Assessments is doing for being able to have a single point for understanding of many parties. And so I think that is another way that it is being tackled. These aren't mutually exclusive. All of these can operate, can cohabitate in a risk management program.
Yeah, I was just going to add the NHISAC, going back to the Information Sharing and Analysis Center. The National Health ISAC has come up with an approach to share that information across their members, providers, as well as payees and things of that nature. So you may want to look at that.
So another question for you, Jim, is you talked about enlisting the tier 1 suppliers or third parties to help with your tier 2s and tier 3s. Can you elaborate a little bit on that?
Sure. Look, I think a lot of companies that are using services or tools like ours and others in different control areas, you're spending the money to be able to have insight into your third parties. Many of those third parties, particularly in financial services where a lot of third parties are going to be smaller, a lot of fintech companies and so forth, you're opening up the subscription and the resources that you have brought on board to allow some of those tier 1s to use them on their tier 1s, and then the 3 parties share that information. That is a very logical way of being able to take, in a very efficient way, the resources that you have onboarded and decided are a meaningful part of your risk management program, and allowing your tier 1s as a benefit to be able to use some of those services. That is something that we think we're going to see more and more, and it gets back to a very common theme which we discuss, which is that transparency in risk management is critical, and communicating that there's a commercial value to that transparency is essential. And if your tier 1s understand that and they're communicating very confidential information in a very secure way so you can have the benefit of understanding them better, they're being able to extend that down a tier or 2 is just the logical extension of the risk management programs that you're putting in place.
Great. Charlie, a question for you. You referenced something called 4 lines of defense.
Yeah, I don't think I may not have meant that, or maybe it was misheard. It's 3 lines of defense. The first line of defense is usually the business unit that basically has responsibility to address the risks that have been identified. There's a lot of talk about like a 2.2 plus line of defense and things of that nature, so there may be some variations. But first line is typically the risk owner, business. Second line is usually a corporate function that tries to coordinate activities, policies, and procedures and things like that. And the third line of defense historically in the financial services arena has been the audit group that basically monitors and looks over that. So those are the 3 lines. And there's variations of 1.2, 1.5, or 2.5, so depending on who you talk to. Hopefully that clarified that.
Makes sense. So both you, Jim, and Charlie referenced some form of monitoring, and so this question, this is a rather broad question, but I think it's a critical question, is what are the best steps or advice should the panel have for keeping up with regulatory requirements? So regulatory requirements are changing so quickly, so maybe a good question for you,
Yeah, sure.
Charlie, and maybe Nick.
Sure. What we've done over the past 2 years based on membership direction is basically mapped all of our tools to various regulations, and we have maybe about 15 to 25 regulations that we try to keep on top of. There's a number of challenges with that because you have to do not only map to, but map missing pieces that are not covered, and sometimes the regulations don't always address just third-party risks, so they're broader than just third-party. So we continually do that. We're doing that now, and we have some people that work on that to look at that, and we review that with the membership and get that information back. There's other organizations that do that as well, and we're exploring opportunities to kind of look to see how we can do this more holistically. So.
So Nick, I have a question.
Yeah, I mean, I'd echo that. Just from from our perspective, we would obviously ensure that we have specific researchers who are aligned to certain jurisdictions, particularly the main ones. We see a lot of variation if you look across Asia, particularly around Japan. So the ABC regulations do vary quite widely. A parallel you could take from anti-money laundering would be to look for the higher standards, if you like. So you look at the kind of the US, the UK, Europe. Look at what they're doing. I think if you can get in line with those standards, you're pretty much covered. But if you do operate in other jurisdictions, you need to keep an eye on those as well. It's not an easy task to stay current with it, but I think it needs with the right focus and KPIs around that, it's possible.
So Nick, the last question is for you. Do you see the need in the third-party risk management world for a role like the MLRO, risk officer role, similar to there is in the anti-money laundering world?
Yes, I do. I think it very much depends on the maturity of the organization and the size and scope of it. It can be potentially an overkill for smaller SMEs. I think it sends the right regulatory message, though, to actually appoint somebody and be accountable for that and ensure that they have the right level of representation at board, depending on how high up you want to go. But I think that's a good question, and it does play very much, again, to learn from the AML challenges and learnings that they've experienced over the last 10 to 12 years. And that's you getting the organization in the right place with the right level to set the tone at the top is a really strong place to be.
Excellent. Well, I want to thank our panelists, and I want to thank the audience for participating. And we will, if we didn't get a chance to answer your questions directly, we will answer them through email. So thank you, everybody, for spending the time with us today. Thank you, James. Thank you, Charlie. Thank you, Nick. And we look forward to welcoming everybody next time. So everybody have a great day.
Thank you. Happy Valentine's Day out there.
Thank you, Charlie. Thank you, everybody. Bye.
It's a pleasure. Thank you all.